Stephen Macklow-Smith, you're a portfolio manager at J.P. Morgan Asset Management here in London. Now there are two political events that shake the world, the Brexit vote. Now we have a timetable when Britain wants to start leaving the EU. Have you taken any provisions? Have you reduced risks because of this situation?
We actually reduced risk before the vote because we didn't want to second guess the outcome of the referendum. It was a binary event into which we felt we had very little insight. It was clear that the market was expecting a particular outcome, and it got the outcome that it wasn't expecting. So in the immediate aftermath, there was quite a significant correction. But we'd reduced our exposure to the domestic UK before that. We were still slightly overweight because we still felt the fundamentals were good. And if the vote was a yes, then we felt those stocks would do very well. But since then, we haven't really made that much of a change to the portfolio because we'd reduced risk, and we've stayed with that slightly reduced level of risk.
And the US election is coming up, the other event I wanted to talk about. Now, there again, you have two possibilities. Have you taken any provisions for that?
We think that more or less whichever candidate wins, there's going to be a slight cloud, probably over pharmaceuticals. But I think the most important point to understand about the US election is that whoever wins the presidency, it will be as important to see what the political makeup of the House and the Senate is. Because we've seen with the presidency of Barack Obama, you can be president, but if you can't get legislation through Congress, then you're unable to carry through your program. So we've seen a lot of rhetoric from both candidates, but how much of that they will actually be able to implement is another question entirely.
You mentioned healthcare. What is your prospect of this sector for the coming weeks or month?
Well, it's a bit difficult to talk over sort of a week or a month's time period, but from where we stand, healthcare is one of the great strengths of quoted Europe. Corporate Europe has some absolute giants of the global market, and healthcare contains many of those champions. We think that in the short term, the outcome of the US election, particularly if it's a win for Clinton, may result in a perception that there's going to be more price pressure and more encouragement for generics. But when we look around stocks in Europe, we think that the drug pipelines are reasonably healthy. And with things like the Bayer deal for Monsanto going through, it's very clear that those stocks that are able to generate lots of capital are looking to reinvest it judiciously and create premium returns.
So you're also positive for our own Swiss players like Roche and Novartis?
We think they're brilliantly positioned in the long term. So in the short term, there are always tactical considerations. But we think that Roche and Novartis will remain industry leaders certainly for the rest of my investing lifetime.
So the European stock market in general, we mentioned the healthcare sector, but what other sectors do you think are interesting right now?
Well, we think one of the things that's changing is that growth is recovering. So at the start of the year, there was a perception that growth was under threat around the world, and particularly in China, there was talk of a threat of a Chinese hard landing. We always thought that was very unlikely, and now we're seeing evidence that actually emerging markets are starting to turn the corner. So it's at very early days in that recovery at the moment, but you're seeing in the performance of emerging market equity markets relative to the world that there are signs of life, and we think that will continue. The great thing about Europe as an investing area is it's so diverse. So more than half of European corporate revenues come from outside Europe, and that means that whatever's going on in the world, you can normally find a sector that will benefit. So our sense is that in the short to medium term, actually there are quite a lot of opportunities in cyclical areas. Capital goods would be an example. Defense, which again could benefit from the outcome of the US election. And we also think that the domestic Eurozone economy is recovering nicely. So, people like retailers, we think that there is still more upside there. From a valuation perspective, we don't think the market is particularly expensive. We think it's on the cheap side of fair value. And of course, relative to bonds and cash, equities look very attractive indeed.
Is there an alternative to equities?
Well, we think real estate continues to benefit from the ECB's quantitative easing program. You can play that through quoted real estate entities in Germany and Austria and so forth, or you can go direct. But we also think that the credit markets still look okay. Spreads at the high quality end we think are very compressed. But if you're prepared to compromise on quality, you can still get a yield pickup. And I think that investors in government bonds, it's going to be a bit of a struggle for them over the next year or 2 years.
Stephen Macklow-Smith, thank you very much for your insight.
Pleasure.